Well, there are three reasons really. The first one is growth. You have high structural growth in frontier markets, and from this perspective they look like emerging markets maybe 30 years ago. When you look at an average frontier market, you see 4 to 4.5% GDP growth. The range is pretty wide, 3 to 7%. Some markets are growing by 5 to 7% every year. Some are a little bit more mature, growing by 3 to 4%. But when you compare this 4 to 4.5% average growth to emerging markets, you see that emerging markets on average are growing by 3.5% a year, and developed markets are growing by 1 to 1.5%. And the second reason is a bit of a surprise to many, and that is frontier markets have lower volatility compared to both emerging and developed markets. And the third reason is mostly about valuations in frontier markets. These markets are going through a lot of distress, a lot of challenges, but they are also showing high growth. And that comes at a price for equity investors. When you look at overall pricing of frontier markets, we are talking about 7.5 times price to earnings ratio for our strategy, for instance. And these companies are really growing at 15% a year. So when compared to emerging markets, which trade at 11 times PE, or developed markets which trade at 18 times PE, you have a significant re-rating potential, but more importantly, even if this re-rating is not coming over 1 or 3 years, you have good downside protection in frontier markets with the potential to re-rate to come closer to at least emerging markets over the years. And when you invest in an actively managed strategy such as East Capital Global Frontier Market Strategy, you have lots of stock picking opportunities on top of the overall investment case.